Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian currencies hit two-decade lows against the dollar and equities fluctuate as investors become wary of risk from looming U.S.-China trade tensions. That stronger dollar, higher yields and Trump's tariffs forcing Goldman Sachs to cut its target for Asian stocks. The chief APAC equity strategist Tim Moe will be joining us very shortly. Also ahead, South Korean investigators ask police to execute a warrant to arrest President Yoon Suk-yeol after their first attempt failed. And Canada's Prime Minister Justin Trudeau reportedly set to step down as soon as Monday under pressure from his own party's fears of an election wipeout. We're keeping a very close eye on the yuan. That yuan fixed today stronger than 7.2, suggesting perhaps the PBOC unwilling to see an accelerated decline in the currency, not reflecting, some say, the state of the Chinese economy. That Chinese currency trading at 732.71. The big question some are asking is whether or not you can stop that slide to 7.5. Defending 7.2, they say, is really going to be a difficult task for the PBOC. In terms of the Asian currencies, it is a strong dollar story. We're seeing Asian currencies pretty much at the lowest level in 2 decades. Traders anticipating that Trump policies will mean U.S. exceptionalism, putting pressure on those Asian currencies, notwithstanding the Aussie, the Kiwi, pretty strong as we speak. And add to that, the Vietnamese dong also having quite a day on the back of the GDP, beating estimates 7.1% versus estimates of 6.5%. Let's take a look at how the CSI is trading, testing that low end of the post-policy pivot range. Of course, under a lot of pressure, traders anticipating those tough Trump policies to continue to put pressure on Chinese stocks. Now, some of our guests have also been keeping a cautious stance on China. Yadani Research President Ed Yadani told us last week that the country remains uninvestable despite government measures to boost the economy. Grow Investment Group Chief Economist Hao Hong also says stocks are not attractive enough to buy into.
A lot of companies, U.S. and other companies, are deciding that the China market just doesn't have the potential that they thought it would have. It had a good 2024, especially later in the year as the government came in with some monetary and credit stimulus programs. But now it seems like they're running out of magic here, that if the fiscal stimulus can't do the trick.
I think it's still not attractive enough for me to buy. I mean, even though the liquidity injection before the Chinese New Year tend to be very strong, but it's also, expected by the market, right? So because every year they more or less do the same thing.
Let's get to our guest, Timothy Moe, his Chief APAC Regional Equity Strategist at Goldman Sachs. Tim, good to have you with us. I mean, strong words from Yadani saying uninvestable still. And Hao Hong also not convinced. I mean, to be fair, Chinese stocks are off to their worst start in a decade.
Well, there's a lot we have to unpack, Haslinda. First of all, thank you very much for having me on. It's a pleasure to be here. But the word uninvestable is, I think it's not very helpful because this is a roughly 10 trillion market cap market overall, if you take the A shares, the H and the ADRs. And it trades about $150 billion a day. So the idea that it's uninvestable is kind of a sweeping statement. So I think that's not terribly helpful, frankly, way to characterize things. I think it's probably better and more insightful to say that it's very challenging and complicated to invest in China, and it seems to us from the data we look at that the constituents who are investing, the people who are investing in China, that constituency is shifting. So it's very clear that U.S. investors have decumulated, disinvested, some of that being intensified or required by government edict, if you would. Texas and I believe one other state have actually just issued proclamation saying that public pension funds cannot invest in China. So, there's either a legal or a strong overarching effort to reduce the amount of U.S. investment that's going on in China. Having said that, if you look, for example, at southbound Connect flows into Hong Kong, and just to remind your viewers that southbound Connect is mainland Chinese money coming into the Hong Kong stock market, the amount of flows that came in 2024, last year, was over $100 billion US dollars. So Chinese investors are buying, quote, their own market. So I think that one of the themes that we're seeing is a shift in leadership and ownership from foreign investors, particularly U.S. ones, which is obviously informed in part by geopolitical tension and so forth, which we can get into in our conversation, to more domestic investors. The other point I think is very important to emphasize is that the requirement for China to do well, and what our assumption is, but it's very much the critical ingredient in our tactically constructive view on China equities, is that government policy does come through. Now, we think it will do. We can unpack more of that in our conversation, I'm sure. But as sort of an opening, observation, I would say that you've got this shift in ownership of Chinese equities, and the requirement for equities to resume their upward move, which we saw a very powerful move in September and October, and we've corrected about half to 60% of that. To get to sort of stabilize here and move further up, we're going to need clear and more tangible evidence of policy support.
You talked about how the national team has been boosting Chinese stocks. We're talking about what, I think 6% of the valuation of Chinese stocks as a whole. I'm just wondering whether that is good enough for you to make an overweight call in Chinese stocks.
So it's not dependent on the national team. A national team sort of comes in at times of particular stress and will sort of form a bottom in the market, or a short-term bottom in the market. I think what's required here is further evidence of Chinese policymakers implementing the so-called Beijing put, the idea that they want to take out the so-called left-tailed risk, the downside risk in growth. We think that clearly happened with the September 24th set of policy measures. That was when the PBOC and the CSRC and the National Finance Regulatory Authority, those are the three key monetary bodies, they had a joint press conference, as you may recall, which basically really signaled the shift in the market. That was quickly followed by a succession of other press conferences showing that there really was a policy pivot. I think that was enough to get the market going. In fact, it was a rally of nearly 50%. But we need now to see further evidence of the implementation of that. Now, we do expect that. We think that monetary policy would turn more accommodative. That we're expecting two 20 basis point cuts in interest rates. We're expecting two 50 basis point cuts in the reserve ratio. We think there will be a significant increase in fiscal support. The broadest measure of fiscal is what we call the augmented fiscal deficit. That's both the central government deficit plus the more broad provincial deficits. We think that will increase close to 2% of GDP this year, which is significant. So we think there are efforts to support growth. And if that happens in the context of a market which, as of last night's close, was trading at 9.7 times forward earnings, and where positioning is still light, we think that the combination of that could get China to go back up this year.
But the thing is, all the stimulus measures that you've announced are pretty much factored in. That's why we saw the Chinese stocks gaining at the end of 2024. How much more upside can you expect?
Well, I say yes and no. So to just get some numbers on this, so the trough of the market was September 11th, and we had, as I said, about a 50% rally, close there too, into the second week of October. Since then, we've given back about half of that, or a little bit more. So put that in valuation terms, we went from just below from 9 times earnings to 11 times earnings. And we've now corrected, as I said, back to sort of just under 10 times earnings. For a variety of reasons, which we've articulated in our research, we think that 11 times earnings is roughly what we think would be, quote unquote, fair value for China in the context of the macro and political and policy and so forth environment that we're expecting. So if indeed China comes through with the policy support, could you get a moderate recovery in valuation from, in round numbers, 10 to 11 times? And then as you go through time, you can also have some underlying earnings accretion, which we think will be sort of high single-digit earnings growth. If you put those together, about a 10% valuation expansion and about 8 to 10% earnings growth, that could get you high teens type of return. And we've seen that China can do that in like a week if the sentiment turns. So, I agree that China is very difficult to invest in. And one additional point that's maybe helpful for your viewers is that many global investors that we speak with have really disinvested or just said, look, China's not worth it for me. I actually have a fair amount of sympathy for that. I can understand why they have that view, because if the global market is your playing field, so to speak, and China now is only about 2.5% of the global ACWI, All Country World Index. U.S. is 65%, thereabouts. If you have nothing in China, you're not taking that much benchmark risk. And China, as we know, is hard work. I mean, I spent like I covered the region, but I spent half my time on China, right? So, you have to really put the effort in. And a lot of people are saying, look, the risk reward of putting the effort in versus the return may not be that great. But for those who are willing to do so, we think there's opportunity.
When you take a look at Chinese assets, are they rightly, correctly reflecting the Chinese economy? Take a look where the yuan is trading. It's been well supported by the PBOC. Take a look at how, the bonds are trading. We're talking yields, perhaps testing one. We had Yadani saying close to zero.
Yeah. So China is clearly suffering or experiencing deflationary challenges. I mean, there's no doubt about that. And I don't want you to think that, oh, we're just Pollyanna, China's great. No. We've written extensively on all the challenges that China has. But we have to remember is that as investors, our job is not only to understand what are the fundamentals, but how are those priced in the asset markets, and then what is the risk reward given our expectation of what's going on. So the larger argument that I guess we're trying to articulate is that we are in full recognition of the significant macro challenges that China faces, but we also think a lot of that has already been priced into the stock market after China had performed for 3 years in a row, and last year was the first year it outperformed and had a positive return. So, what we're trying to do is just say, where do we think the intersection of fundamentals and market pricing is? What kind of catalysts or developments do we expect? And does that give us, what is the risk reward that we think is a function of that? And that leads us to this sort of tactical overweight on China, right? But we do think it's more of a trading view than a sort of a long-term structural view for some of the macro concerns that we've articulated.
Okay, Tim, hang tight. Timothy Moe, Chief Asia Pac Regional Equity Strategist at Goldman Sachs, is sticking with us for the full hour. Meantime, some headlines to tell you about. We have the Japan Coast Guard saying that North Korea is suspected of having fired ballistic missile off Japan coast, and Yonhap also reporting that South Korea Joint Chiefs of Staff saying missile fired into the East Sea. Of course, we've had anticipation of North Korea taking advantage of the political chaos in the South to perhaps make those moves. Still ahead on Inside, more on Korea. Hear why the Stimson Center's Kaitlyn thinks South Korea's impeached leader will not go down without a fight as the U.S. Secretary of State arrives in Seoul amid an entrenched political crisis. Keep it here with us. This is Bloomberg. Welcome back. You're looking at live pictures out of Seoul. South Korean investigators have asked the police to execute a warrant to arrest President Yoon Suk-yeol. The court-issued warrant is set to expire by the end of Monday. The investigators' initial attempt to arrest Yoon last week was unsuccessful and led to a standoff with a security team and thousands of supporters. It's still unclear when or if a second arrest attempt may happen. Let's get perspective on the latest developments in South Korea with Kaitlyn King, C38 North Program Assistant at the Stimson Center, a foreign affairs think tank, and Goldman's Chief Regional Equity Strategist Tim Moe is still with us. He has a market weight call on South Korean equities. Kaitlyn, let's start with you. How are you reading the latest development in Korea?
Yes, thanks so much for having me. And there really are so many questions and lots of uncertainty here. So as it stands, it appears that Yoon is going to continue to fight. He said himself that he would fight this to the end. And this can be seen in his multiple refusals to cooperate, the standoff that we saw just this past Friday, his team's accusations of the detention warrant being illegal. We can see that he's really going to stand by his position and fight the impeachment and arrest and those warrants till the very end. So this has caused a lot of uncertainty, not just in South Korea, but also for the U.S. and and its other allies and partners, and honestly, the world as a whole as it watches on.
It's become a really complicated process. We know that if that arrest is not done today, Kaitlyn, it does seem like another warrant will be needed.
Yes. So as it stands now, the warrant is set to expire at the end of Monday, January 6th, which in Korea time gives just over half a day for that to follow through. Now, the anti-corruption agency has since passed on the execution to fulfill the warrant to detain Yoon onto the police. So it's hard to say whether or not that'll go through. The police and other officials are reviewing that and planning their next steps forward. So we're waiting to see whether or not that'll go through. However, even before this, there has been talks from the anti-corruption agency to either extend the warrant or to renew it and submit another request for a warrant that then would give a little bit longer.
Tim, let's get you into this conversation. I mean, what's happening in Korea is a reflection of all the vulnerabilities and geopolitical tensions you can expect in 2025.
Yes, I mean, obviously, Korea, the presidential issue is specific to Korea, but I think if we broaden this out for a moment, one of the issues that investors are concerned about, and we're also very mindful of, is that if you, first we have political uncertainty, which obviously is always a challenge for markets, but second of all, if there's going to be a shift in leadership and one towards the opposition, that calls into some concern or question the extent of Korea's commitment to some of the defense treaties that it's got with the United States, and whether the opposition might be perhaps more friendly towards China and might reduce its commitment to the U.S. And I think one of the delicate balances that we have in Asia currently is a kind of a loose coalition of players who are pushing back against some of the hegemonic expansion that China has been making in the South China Sea, for example. And so if you have a change of government in Korea, that could threaten some of that delicate balance. And I think that's something which geopolitical observers are keenly mindful of.
So what does it mean for Korean stocks? I mean, it's hard not to be bearish.
Yes. So there's lots to unpack here. So humor me for just a moment. So there clearly are a number of negatives that are going on. I mean, number one is this political uncertainty, which is obviously not helpful. Number two is the fact that you've got, for the largest sector, which is semiconductors, you've got a cyclical softening in DRAM and NAND prices, which we think is somewhat intensifying into the first quarter. Now, the market's aware of that, has discounted some of that, but I think that still is at play. Thirdly, the largest stock, Samsung Electronics, of course, has had its own annus horribilis, to coin that term, in terms of really falling behind Hynix in terms of the high bandwidth memory chips that they would like to sell to NVIDIA. And so it's fallen behind on the AI theme. And so you've had this conflict. And then, of course, Korea is the most globally cyclically sensitive economy, currency, and stock market. And so in an environment where global growth is, we think it's still good in absolute terms, but it is slowing, and you've got all the concerns about tariffs and so forth, which we'll get into later in conversation, those are kind of all the bads. Now, having said that, Korea was the worst performing market in Asia last year, down 26%. The market, as last night, was trading at 8.7 times earnings. Sorry, 8.0 times earnings. That's 1.8 standard deviations below its 10-year mean. Foreign investor exposure is at the decadal lows. So a lot has been baked into negative prices. The other point, which I think is important to make, and our senior Korean economist Goon Kwon just wrote about this in a report this morning, is that the current sort of fractious government did manage to pass on a bipartisan basis a new budget. And the budget was actually fairly supportive from a fundamental perspective because, A, you've got further fiscal expenditure, which has been accelerated to support the economy. B, you've got the National Pension Service likely to hedge the currency and support the currency, which reduces some of the upside risks to the Korean won above the roughly 1450 level. And thirdly, kind of flying under the radar screen, you've had some progress on the Value Up program, where there's tax advantages for companies both paying dividends and investors receiving dividends. So, all is not lost, but I think it's going to be difficult or tougher sledding, so to speak, until you resolve the current political crisis. So, the net of that is that we're market weight on Korea. We think there's an opportunity from a valuation standpoint, but we need to see some further stability before we'd want to take a little bit more positive
We know
tone.
that Korea is vulnerable to Trump policies and Trump tariffs. Kaitlyn, though, we know as well that the U.S. wants a stable Korean peninsula. And as we speak, we know that Anthony Biden is in the country. How significant is that visit, and what really can the U.S. do?
Yes, so I agree that we are in a precarious balance that we are facing. I don't believe it's quite yet time to sound the alarm. And I think Blinken's visit just exemplifies this. Over the past few years, the U.S. and South Korea have continued to strengthen their relationship, achieving a comprehensive strategic partnership that has elevated the alliance to a stronger point than it has been ever before. So even before this whole martial law instance, the two sides have both been working to strengthen and institutionalize cooperation. I know they were looking forward to a potential second Trump administration and really wanting to nail down cooperation and the status quo, lest he attempt to roll back some of those commitments. An example of this was that they settled a burden sharing agreement in terms of the troop and commitments of the U.S. on the Korean Peninsula. And so, again, this visit by Blinken to South Korea shows how committed both sides are to maintaining cooperation, communication, and balance, and openness and support through getting through and resolving the situation.
Are there concerns about the Korean Peninsula? I mean, just slightly earlier, we talked about those headlines coming through suggesting that North Korea fired those missiles. I mean, might North Korea take this as an opportunity to make some moves on South Korea because of the political chaos?
Yes, well, there is a lot of concern. This isn't necessarily new. North Korea's response to things going on in the world, not just on the peninsula, but even to the U.S., the Ukraine war, other things going on, that's not new. So we don't necessarily have to be as concerned or shocked by these actions. In fact, it was almost more interesting to note how in the first week of Yoon's declaration of martial law, North Korea remained silent on the fact. So it is definitely important to watch what happens moving forward, the statements North Korea makes, particularly what comes out of their upcoming Supreme People's Assembly meeting and potential amendments to the Constitution. What comes out of that will likely be more impactful than any testing or statements that come out in the meantime.
Kaitlyn, thank you so much for joining us. Kaitlyn King of the Stimson Center joining us from D.C. Tim Moe of Goldman sticking around. Let's take a look at how Asian benchmarks are looking. Tepid performance this Monday morning. Of course, there are concerns about Trump as we await the man getting back to the White House. Still to come, Nippon-US Steel saying it plans to challenge President Biden's decision to block its U.S. steel takeover. We'll look at whether the deal has any hope of a revival. That's coming up next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. A gauge of Asian currencies has hit a two-decade low, dragged by losses in the Chinese yuan, which breached a key level. Meantime, the yen is leading declines in the region. Avril Hong is here with more. We're waiting for more losses for the yen. Avril?
Yeah, I mean, we're already seeing it today, right? Not only is it leading declines in the region, but among its G10 peers as well. And this is after capping off 4 straight years of declines. And in many ways, the themes of 2024 carry on into this year. You think about greenback strength likely to be retained given how Trump is pursuing this America First policy, and the BOJ just frustrating traders not being fast enough in its pace of normalization. Today, the BOJ governor pretty much reiterating his existing stance, saying, yeah, we'll raise rates if economic conditions continue improving. And that's despite the data already backing the case for the BOJ to hike rates. You think about early signals from wage negotiations, those also look pretty promising, yet the BOJ has been pretty slow to act. So all in, yen weakness is expected. BOJ also not expected to move later this month. But let's flip the board, because I guess the expectations of the BOJ eventually moving are being reflected in Japanese bonds. Some of this is also tracking the recent weakness in treasuries. The yield on the 10-year today hitting levels we haven't seen since 2011. In terms of Japanese stocks, today it's a catch down perhaps to what we've seen on Wall Street. The yen weakness not quite helping. We have some strategists thinking that 2025 is going to see fresh records for Japanese stocks thanks to earnings looking robust potentially, but also that continued corporate governance reforms. On the stock of Nippon Steel, of course, this company has been in focus. Biden has made formal that opposition to the takeover of U.S. Steel and scuppering this $14.1 billion deal. So the focus now really shifting to what this means for U.S.-Japan relations and where this Japanese steel giant is going to look for in terms of growth opportunities, Has.
And what it all means for deals in general. Avril Hong, thank you. Let's talk more on Japanese markets. Tim Moe is still with us. Tim, let's pick up on where Avril left off. You know, Biden saying no to Nippon Steel buying U.S. Steel. It is about national security. You got to wonder what it means for deals generally going forward, and also what it means for, investor sentiment.
So it depends on which deals we're talking about, if it's cross market or within market, et cetera. Maybe I just step up a level here and just summarize our view on Japan, because we're constructive. It's probably one of our strongest views. And I think the key concept is that, at least with the recent investor conversations we've had after we put out all our 2025 year ahead views, we had a lot of meetings with investors globally, both me and my colleagues. And I think there's a general appreciation of the positive investment case for Japan, which I'll articulate quickly in a moment. But the evidence is clearly that foreign investors have actually decumulated from Japan and that their holdings are quite light. So the key concept here, Haslinda, is that there's a sort of positive investment gap between where people's minds are at versus where their wallets are at, so to speak. And so we think that can be closed in a positive direction with more buying coming into the market and driving Japan to further highs. And we think new highs are in store. Why is that the case? Super quick, the weakness in the yen roughly translates every 10 point move in the U.S. dollar Japanese yen rate on an annual basis basically improves earnings by about 4%. So if we've got a weak yen, we still think we're in a strong dollar environment. That should result in some better earnings. So we think earnings will grow roughly around 9% this year and next. Market's trading about 14 times earnings. It was trading well above 15 at the peak last July. So we think we can still recover some of that multiple correction. So if you put the underlying earnings along with a bit of valuation recovery and some underlying buying by foreigners, we think we can get sort of mid-teen returns for a large and liquid market, which has many interesting investment themes within it, which would include, not to enumerate all of them, but at least one or two of them would be obviously one, the BOJ normalization. That's going to be good for banks if you steepen the yield curve and so forth. Two, we were talking about geopolitics before and so forth. We think the theme of defense spending across Asia, but also very much in Japan itself, is a really viable and good theme. And then number three, you do have some domestic reflation, which is taking place. Nominal GDP, we think, will grow about 3% in Japan this year. And so that should be better for some of the consumer stocks. So we've got a number of themes. I just would mention those three within the market.
In the end, would that be a reflection of what you can anticipate in other markets in Asia as well? I mean, you talked about how Japan can withstand that strong dollar environment, U.S. exceptionalism. Not quite the case for the rest of Asia. I mean, what are you keeping an eye on? Which markets in particular?
So Alain said, let me just step back just one moment. The key construct that we've got and why we've thought we were going to be off to kind of a slower start this year are really three interrelated macro factors. The first is what we call a more challenging macro mix, which is that after the U.S. election, we've got a less favorable mix of growth rates and currency, right? So on the growth side, U.S. is doing great. We're actually above consensus. We're quite constructive there. But most of the rest of Asia will slow somewhat. If you roll it all together, we're looking at Asian growth slowing from about 4.8 to 4.5% this year, and then maybe slowing a little bit further into 2026. So it's not that growth is bad, but it's going to be moderating. And then, of course, we've got higher U.S. rates. We've seen a very significant backup in U.S. long rates, and the market is less optimistic about the amount of Fed cuts which are taking place. And then that maps very quickly onto further U.S. dollar strength, because if you don't think the Fed's going to cut as much, and for example, we think the ECB would cut maybe 50 basis points more than the Fed would this year, that probably intensifies the downward pressure on the euro, for example. So the point here is that dollar strength has typically been associated with weak Asian equity performance, right? And so the combination of slower growth, higher rates, and a stronger dollar typically is not a great environment. So that's sort of the delta which took place. And then that maps secondly onto the tariff issue, which is coming up because the presidential inauguration is January 20th, so that's just a couple of weeks away. And it's likely that the Trump administration acts more swiftly this time around than they did the first time. And then the third thing, of course, is both economic policy uncertainty and geopolitical risk, which have negative implications or challenges for both earnings growth and valuation, right? So you take those three things together, it's a more challenging environment for equities. But as we were saying earlier in the conversation, we also have to understand how much is priced into markets, and valuations are generally pretty acceptable for most of Asia. There's variances within the region, but generally they're pretty good. And even though we cut our earnings numbers a bit in the piece we just put out this morning, we're still looking at about 10% EPS growth for Asia for this year next. So it's not bad, but it's not like super great. And therefore, really the message for investors is probably expect an okay but a bumpy year, kind of like we had last year. And the key issue for active investors is where do you look within the region for the opportunities, one of which, as I mentioned, would be the defense theme, just to pick one out.
So Japan is a way to diversify the portfolio. Tim, before we continue our conversation, just a headline coming out, NHK reporting that the missiles fired by North Korea landed outside Japanese EEZ. So something to tell our viewers about. Just to continue our conversation with Japan, it is also about what the BOJ does. I mean, it possibly would be the only central bank out there to be raising rates this year. I mean, what are you anticipating?
So we're looking actually for the January 24th monetary policy meeting. We think that they would raise 25 basis points then. There is a risk that that slips to either March or April. And then we think there will be one more 25 basis point increase sometime in the second half, maybe in the third quarter. So that's our expectation. That should serve to moderate the depreciation in the yen, because we think the Fed will cut. We're slightly more dovish than consensus. We're looking for 3 Fed cuts. Market's pricing somewhat less than 2 this year. I won't go into the reasons why, but I can if you wish. So the rate spread between the U.S. and Japan is going to narrow. But it still is going to be significant, right? So, so the challenge for currency investors is that the yen still should be a funding currency, because you could still, short yen and it will cost you maybe 1%. You can invest in U.S. dollars, you can still get 3.5 to 4%. But the delta on that is in support of the yen. So with the yen having backed off from 142 to 157 currently, we think the further upside here is not that significant. So we think at current levels, you're kind of in a sweet spot where you've kind of already done, quote unquote, the damage of currency depreciation, but you're still going to get the benefit of the earnings accrual from a weaker yen. So if the yen just hovers around in this mid to high 150 level, that's pretty constructive for Japanese equities in our view.
What's the biggest risk for the Japanese market right now? I mean, we talk about possible disappointment, right? I mean, we've talked about that in China, for instance, and even in Japan, the BOJ has disappointed time and time again.
Yeah. I mean, there's a number. I mean, I'd say if there's any faltering in the kind of reflationary view that Japan growth is coming back. Last year, growth was actually 0% because of a weak first quarter because of auto manufacturing outages in the first quarter. So you kind of get this normalization back to roughly about 1 and change real GDP and about 3% nominal GDP. If there's any faltering in the underlying growth outlook, obviously that's going to be a negative. If the yen was to really become much weaker, then I think you go from where a weak yen is beneficial to a weak yen becomes more concerning. It's sort of there's a sweet spot for how much weakness you can have, after which it becomes more negative. So I think those would be at least 2 things that I would point to.
All right, Tim, hang tight. Tim Moe, Chief Asia Pac Regional Equity Strategist at Goldman Sachs. Still sticking with us. Well, Goldman's Tim Moe staying with us to share his outlook for Indian equities in 2025. More of his insights next. Keep it here with us. This is Bloomberg. Well, Canada's Globe and Mail say Prime Minister Justin Trudeau is expected to announce as early as Monday that he will resign. He's been under pressure from his Liberal Party to step down over fears of a crushing defeat in elections due this year. Let's bring in Bloomberg's Vancouver Bureau Chief, Thomas Seal. Thomas, of course, he's been under a lot of pressure the last several months to step down. I mean, how real is this threat now?
It's been getting gradually more real and unignorable. The polls have been pointing in one direction for well over a year, with a sort of 20-point polling deficit behind his Conservative opponent. That's resulted in a couple of special election losses, crystallising that this is real. And then in December, his deputy, Chrystia Freeland, stunningly resigned, one of his most loyal cabinet members and finance minister, on the day she was meant to be giving a financial update for the nation, resigned and criticised him for his style of leadership. And how he was seemingly preparing for the prospect of a Donald Trump presidency and a trade war with the US. That really kicked things up into overdrive, and just before the Christmas holidays. And so he's taken some time to reflect from all, by all accounts. And time seems to be up. According to this report in the Globe and Mail, at least, he could announce his resignation in the next 3 days.
It is still not set in stone. I'm just wondering, what are the possible scenarios? If he doesn't step down, might there be a vote of no confidence, for instance? What's the likely scenario there?
From what all the other party leaders have said, there will be a vote of no confidence that would topple the government in the next few months. The timing of that is down to a few different parliamentary mechanics. It could be as early as March. There's a possibility that Justin Trudeau could do something called proroguing the government. He would have to ask the representative of the Crown to do that. If she says yes, then that would add a few weeks. So the latest the election could possibly happen is October, but it seems like it's going to be happening earlier than that now. This is all happening not with ideal timing, because Donald Trump becomes president on January the 20th in 2 weeks' time. And so, you can't have a leader. Well, you can have a leadership race, but it's certainly not ideal to have one at the same time as tariffs are being lobbied back and forth.
What's the likely reaction from investors if you take a look at the loonie? The Canadian dollar is currently up versus the USD as we speak on the back of the news.
Well, traders, probably have seen this coming for some time. I think the loonie has certainly not been performing well over a longer period of time, and that's due to a whole host of factors. It's correlated with the oil price because Canada is such a large oil producer and exporter. It's correlated with the differential in rates between the Bank of Canada and Federal Reserve. But certainly, lots of businesses are not particularly pleased with the outcomes of this 9-year Liberal government in Canada, and so I think we could see some optimism from business about a Conservative administration, which is where the polls are pointing at the moment.
Thomas, thank you so much for those insights. Bloomberg's Vancouver Bureau Chief Thomas Seal there. 11:46, and has been trading for about 2 minutes now. Let's do a check on how that trading. Remember that Indian stocks had a massive rally in the first 3 quarters of last year, but saw a correction in the fourth quarter. Sensex currently up about 0.1%. The other benchmarks also in positive territory, though. Nifty Bank Index lower by 0.2%. In terms of the rupee, 85.79, pretty much unchanged versus the USD. Now, Goldman Sachs Chief APAC Equity Strategist Tim Moe is still with us. Let's discuss the Indian equity outlook. I mean, do you think it'll find its mojo in 2025?
Yeah. Well, we're hoping. We sort of thought it was going to go mojo light for a while, so to speak. which is that we've had a very constructive view on India, which I know is not out of consensus, but it certainly was, very clear that India, in our view, and I think in many other investors' views, is arguably the best longer-term structural growth story in Asia. In fact, probably in all emerging markets of any market of really significant size and depth. Now, that being said, and as you just mentioned, the market did very, very well again last year into the first 3 quarters and actually into the peak in early October. And we downgraded our view for 2 key reasons at that point. Again, sort of on a tactical basis. The first was that valuations had gotten up to 25 times forward earnings, which is sort of the peak in terms of absolute relative to the region and so forth. Just market had priced a lot of good news in. And secondly, we were pretty clear that both from an economic perspective as well as a corporate earnings perspective, that we would have what we call a mid-cycle slowdown. And in fact, if you look at the economic data, which has come out, where India had sort of the worst quarter in the fourth quarter calendar year that it's had in a long time, it's a bit over 5% on a year-on-year basis. And then also, if you look at the earnings delivery, that was missed consensus by a lot. So, clearly there's some sort of slowing which is taking place. It's nothing to get sort of super worried about because India was going so hot, it's naturally going to correct. But we just think the market needed some time to digest, these developments. So we sort of said, look, let's step away from an active, constructive view and just bide our time. So the question now is, when do you want to re-engage? Because we think people should be, with that mind frame of re-engaging in this longer-term story. And really, it's going to be a function of when the growth kind of stabilizes and starts to improve again, which we think will take place maybe in the second half of this year. And then secondly, the extent to which the market has discounted that. So either, if the market goes down a lot more, we'd be more inclined to improve our view, or maybe you need a little bit more time for the earnings to catch up with valuations if the market's range trading, in which case your re-entry point might be sometime later in the second quarter. But I think the message for investors is, identify the stocks that you like, the themes that you like, and put your toe back in the water when you think the prices are reasonable.
Are you concerned about the slowdown in growth? Some say that it will continue to head that way.
So you always want to be humble in your views, right? Because if anything, we've both been around markets for a while, and markets have a wonderful way of challenging your strongest conviction views. And so I think we have to have a strong dose of humility in terms of unexpected things that can happen. And to your question, it's clear that there could be challenges to growth in a number of different areas. But our core fundamental view is that if you look sort of at the so-called Cobb-Douglas production function, which is labor, capital, and total factor of productivity, labor, India still has a demographic dividend. There still is lots of investment which is taking place, and productivity still has a long way to go. So India's underlying growth potential, we think, is clearly in the mid 6% potential, sort of call 6.5% for the next 5 years, maybe the next 10 years. And the good thing in the Indian market, and this is in positive contrast to China, is that corporate India, empirically and over the last 20 years, has done a much better job of monetizing the economic growth environment and delivering earnings to investors than Chinese companies have. There's a whole bunch of reasons for that, which I won't go into, but the key takeaway is that corporate India really has delivered the goods. So assuming that we can get back to kind of roughly mid-teens earnings growth, which is pretty good in terms of what your global comparables are, as long as you're not paying too much for that, that still seems to us to be a pretty good risk-reward opportunity.
There are challenges. You talk about consumption. We're talking about 1 billion people, but urban consumption has been on the decline.
That's correct.
And jobs is an issue. Quality jobs, are not being created. I mean, those will work against growth and the economy.
Which is true, and that's part of the reason for this so-called mid-cycle slowdown that we're talking about. And I think we do need to see. I mean, the bigger theme in India that's been playing out over the past few years has been the fact that it was very much government-led investment while you had problems in the banking system, and they had to clean up their balance sheets, which meant they couldn't deploy capital to the private sector. And so you had basically a lack of private sector investment. It was all driven by government investment. When the banks cleaned up their balance sheet, that enabled them to extend more credit, and you basically, that plus sort of favorable government policies, encouraged greater risk appetite on the part of the private sector, and so there was much more private sector capex. I think we need to see that story continue to play out and have further investment in infrastructure and various other aspects, which has a positive kind of network effect, which can then sort of both create jobs and improve productivity and help foster growth.
You alluded to India versus China, and of course we've seen the rotation from India to China. Given your optimism when it comes to China as well, I mean, has that played out?
So in the last sort of 1 to 2 quarters, China's outperformed India, right? I think over the longer run that India will be the winner. So that's
longer
kind of
run. What time frame are we looking at?
I mean, over the next. I mean, when we talk to, for example, sovereign wealth investors or private family offices who take sort of a 3 to 5 year view, I think the confidence we'd have in our India view on a 3 to 5 year view versus in China would be greater in India's case, I think, for the fundamentals I quickly summarized, and the fact that China has a number of greater macro challenges. From a tactical perspective, given where the valuation disparity, which we also discussed earlier in our conversation, I think that sort of tilts toward China in the short term. So it's kind of a tactical versus genuine long-term strategic difference in views.
Take it a step further, and the emerging market world. I mean, you know, time and time again, we kick off the year thinking emerging markets will play catch up to developed markets. Will this be the year? Will it be any different?
I mean, there's hope that that's the case. When we frame our global views, you know, really sort of zooming out to the bigger picture, we're overweight equities. And within equities, we're still overweight the U.S. because the U.S. exceptionalism story still plays strongly, even though it's also pretty well priced. But we still think that that dynamism of the U.S. economy, particularly on the tech side, really is hard to replicate anywhere else. And then outside of that, we think that parts of Asia, you know, Japan as well as non-Japan Asia, also look attractive. And the one that we're less favorable on for the time being is Europe, because we think we've got both slow growth, we've got earnings where we're significantly below consensus. We're looking at just 3% earnings growth. Consensus has come down, but it's still about 9%. And even though valuations are inexpensive, you know, if you're going to cut rates, the euro's going to be weak and so forth, we still think that, you know, sort of the burden of proof is on Europe. So that's kind of our view globally.
All right. Nice way to wrap it up. Tim, been great having you for the whole hour.
Yeah.
Tim Moe, Chief Asia-Pac Regional Equity Strategist at Goldman Sachs. Now, before we go, here's a look at tomorrow's program. We'll be joined by Bank of America's co-head of Asia FX and Rate Strategy. We're talking about Claudio Piron for his outlook on Asian currencies given their weakness versus the dollar. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.